All right. Good morning, everybody. So this morning, the dollar made an absolutely amazing move, and that drove the S&P and the bonds. When we talk about these things all the time, and they're more of a muted move, and we just really don't always see how impactful the moves in one product can be and how it affects another product. But this morning, I think we have a really, really good example of why we watch things like the dollar and the bonds. And it's important to note that right around this time frame right there, stocks and bonds began moving in the same direction, right? We already had a catalyst pressing the bonds, and then it bled over into stocks. And we had stocks and bonds moving at the same time and at an exaggerated pace. If you don't trade the bonds much, or if you don't really pay too much attention to them, you may think that this move is just kind of, whatever. But this is a massive move in the bond market. It's just huge. And I have no doubt that we're going to feel the ramifications of this at some point today. We're coming up into a critical level, not just for the bonds, but also for the S&P and the Nasdaq. So, we'll circle back to that. There is a change in contract in the VIX futures. Drag will resolve, so we'll just leave it be. The dollar took one hell of a tumble yesterday after the close. It's not done yet, but we're getting a little bit of mean reversion at this point. We do got the CPI, or as I've heard it referred to from time to time, the CP lie. I don't want to give away all the good stuff, but there is an expectation that it will impact the market today quite a bit, right? We're looking at FX Street, where they often talk about the dollar index. Just keep in mind, right, when we're talking about the dollar index, we're not talking about the US dollar. Just two completely different things. The dollar index has dollars from around the world, right? It's got the euro in it, and just all kinds of things. So as we usually do, we want to start with Thinkorswim Market Watch, 8:30, 10, 10:30, and 2. The 10:30 petroleum status report is something that you could focus on for USO. USO is the oil ETF. It will provide you an opportunity to trade around 10:30 if the report happens to be a little violent. If you're trying to perhaps identify what that trade opportunity could be, go look at previous Wednesdays at 10:30 in the morning on the USO chart and look at how that market responded when the oil report came out. Look at those candles and ask yourself if there was a trade there. Could you have, traded some sort of buy right or just straight up taking some options on it? It's cheap enough you could have just ran some stock. Every Wednesday that report comes out. Sometimes there's no real discernible reaction to USO, but other times we get, a significant move. So yeah, that'd be the 10:30. Just remind yourself you can right click and create an alert. And that way you can give yourself like a 15-minute heads up or a reminder, a warning. It'll ding your smartwatch or your smartphone and remind you, hey, don't forget, you got this thing coming up. We got the beige book this afternoon. And if you've been keeping your eye on the retail ETF, then you're really going to want to watch it today on the expectation that this could have serious consequences to that situation. I know that this current screen may seem a little loud. It's got a lot of things on it. It's kind of nasty looking. Uh, but we're on a daily chart, and we're kind of asking the question. It's a simple question. How far away are we from the 10-period moving average? And when you're talking about a daily and a weekly moving average, the 10-period weekly is a very strong line in the sand. A 10-period weekly is like a 50 daily, right? They're not going to be exactly perfect, but they're really close. When we look at a market and we gauge it against that 10-period moving average, we consider a market strong and healthy if it's above that 10, and weak and unhealthy if it's below the 10. Well, the 10 also becomes like a magnet or the mean in a linear regression dot plot. It's the center of everything, right? Think of it like the middle of the basketball court. So when we're looking at a market, we want to kind of gauge how fast have you been moving. We had a reasonably decent move yesterday. We want to be able to ask a question. How far have we moved from the 10-period daily and or weekly moving average? And are we getting overextended? Now, I really hate the phrase overbought and oversold because it gives newer traders this misguided understanding of what's going on in the market. Something can be oversold and remain oversold for a long, long time. Same thing with being overbought. Something can be overbought and just remain that way for a long time. So I don't really like those phrases. And I don't like what they imply, as if there has been so much buying that it's so overbought that, well, it's got to go down from here. It's overbought. That's absolutely not true. But when we get too far away from that 10, we've proven throughout history that when we get too far away from that 10, we tend to pause and often turn around and go back towards the 10. Now, every market gets a certain distance away from that 10 before it finally starts to consider being too far away. And so I built these indicators so that we could, put whatever market we want on the chart and ask the question, what's normal for this market? When we're looking at the S&P on a 1-year daily chart, the top one is a weekly measure and the bottom one is a daily measure. And on a percentage basis, how far away are we from that 10 period and are we above it or below it? What's been the normal, right? So we can see that around 2% is about the norm when it comes to seeing the S&P pause. So if it's running to the upside and it's making good strong advances and it's outrunning that 10, where is its pause place? That's around 2%. So when the S&P gets around 2% away from that daily 10, it often pauses there, turns around and comes back. This isn't my opinion, right? I'm not telling you what I think. This thing is just doing the math because nobody cares what we think, right? Just care what we can prove, what we know. So we don't have to say, well, I think it's overbought. I think it moved too far. This thing says we have not moved too far. We did not move too fast, and that there is plenty of room left to go, right? Because we're just slightly up. If 2% is the norm, and we're not even at a half of a percent yet, then there's plenty of room. And you take that same concept over to a weekly, and the average weekly is somewhere around 4%. Then we would consider that we've gone too far or too fast. And right now we're just past 0.25% to the upside. Now you can find those indicators in the Thinker's workbook. So we didn't move too far. We didn't go too fast. We have not outrun our moving averages. That's basically what we're getting to, right? That's the gist of the whole thing. So let's just take a moment while we're out here on the daily chart to evaluate what's going on in the S&P. Now we had this day back on April 12th. That was a very large day. And since then, we've basically been running IX10. We've been sitting inside of it. Now, yesterday we did peak outside the bottom of it just slightly and came back inside of the range. And we did hit the top of it and pulled back up off of it, right? But that one candle from April 12 has been the controlling candle, and everything has shadowed inside of it. We're now testing an inside day breakout because we are inside of yesterday's price action. We've been mostly holding above the close, and there is an OCR style of candle reading that talks about a swing low pattern. This would be the swing low, and then after the swing low, we begin making our move up. And interesting enough, after you get a swing low, when you have the new candle open, you can anticipate the drop before the rally. And then you get the close, the new candle opens, you anticipate the drop before the rally. And you would continue to see that up and up and up and up until we no longer are making new highs. And you get a candle that's sitting inside of another candle or an outside bar or something like that, right? So after your swing low pattern, you can almost count on those pullback wicks. Now that analysis, that OCR style of analysis fits anything, right? So even on the intraday, if you're trading, say, as a day trader and you get a swing low set up, you could wait for candle to close, wait for the new candle to open, catch that pullback on the wick before getting your entry, right? And then, of course, if you catch the pullback and get the entry as it's rallying back up off of the wick, the low of that bar that you entered on becomes the spot for your stop, and you put your stop in just below the low of the current bar you are trading. It's an OCR style of analysis and trade. It's fast paced. Depending on the time frame that you want, you can literally dial that thing down into any time frame. You can even do it on tick charts. Right? It doesn't matter as long as you got candles with wicks. So you don't do it on something like Heikin-Ashi charts or range charts, something like that. All right, so we're kind of moving into the intraday a little bit, looking at the S&P, and the main range still holds true, right? The range that we've been looking at for most of the year. But for the downtrend that we talked about yesterday, this swing high and the swing low, the pattern is broken. We were getting lower highs and lower lows throughout that swing pattern, right? But now we have started in the other direction. We've got higher lows and, well, at the moment, lower highs, right? So it's not completely valid that we are making the turn yet because of that lower high, but the higher low is a really good step in the right direction, right? Now, there's all kinds of ways to approach trading. Some people wait for validation, being cautious, looking for all of these confirming signals before they trade. And then there's other traders that anticipate the change in sentiment and jump in before any of those validation signals even exist. It's not about right or wrong, by the way. It's more about your style as a trader and how good you are at money management. New traders focus on winning and losing as if there's some kind of scorecard and you're just trying to rack up wins. More experienced traders focus on money, more concerned with how much do I have to risk here? Can I keep my losses small and maximize my wins? And we don't really give a damn about winning and losing and having a high number of wins because it isn't a video game and it's not a scorecard trying to keep track of our extreme win rate, which is basically impossible to maintain, anyways. Right? Money management above anything else. So, on a conversion like this, where we have stopped getting at lower highs and lower lows, and instead have begun to turn the corner, then we're moving in the right direction. Right. And now, from that, if we get the main, we'll just say that that's secondary trend. If we look at intermediate, from that low, snap a linear regression line, you can see that we've begun the wave back up in the other direction. Now it's still minor, right? Because trend changes come from the lowest time frame and echo higher, and trend validation comes from looking at the higher time frames and taking things down into a lower time frame. So we're getting that reversal. We've started the process with, from this low, high, low, high, low, right? If we were to discount everything else from this area back here as a consideration that we are now turning the corner and moving the other way, then we do have a full set. We've got a full set of higher highs and higher lows. But if we are maintaining our perspective of the secondary trend, then we are not yet confirmed for the reversal. So as you can see, we're coming up into a critical level. We have 44.66. We've tagged that yesterday momentarily, and we almost tagged it this morning before fading off of it. This is a serious line in the sand. And if we just momentarily jump over to something like the ZB, maybe the ZN, we can see that we're coming up into a critical area of resistance here as well. Forms a little micro cup. Of course, the argument could be made that there's the left shoulder, the head, the right shoulder, trend line, catch the break. Bonds have been beat down significantly for quite a while. Price action alone would indicate some form of mean reversion or linear regression, or flipping back over towards the mean, right? Now, a candle like this, guys, should make you concerned. This is like a capitulation candle, um, very similar to a blow off top. Um, if we flip this chart over and was looking at this from the downside, this would be what capitulation looks like, right? You can see how we had, if we were looking at it from a bearish perspective, that we would be breaking to new lows, and uh, it would be an outsized candle, very extreme, very exaggerated liquidation break, hard move to the downside. We'll take all of that and flip it over. put it back where it was. There's your top side breakout, and it's very likely going to be a rejection, right? Just like yesterday, right here. One last hurrah, usually by newer traders who think they are finally convinced that this move is going to stick. They start buying in while the institutions are selling it to them and getting out of it, right? And then, of course, they flip it and roll it over on them. The weekly expected move is right there. Looks like we came really close to hitting it. Uh, we're just getting into Wednesday, and it took 3 days to get there. So that's a reasonably decent time frame. There's been plenty of times lately where we've made the entire move in a single day. So, the fact that it took a couple days to get there is nice and healthy and clean. If I was not streaming, I would have taken that sucker. May still be an opportunity to take it if we break back below 44.66. Maybe look for a little bit of mean reversion or at least a little bit of a Busby at that point, right? Let the candle close, perhaps let it pull back up and hit the bottom of that thing. Find your entry somewhere along there. Depending on the time frame that you're trading, it's already pulled back, right? So if you were on a small tick chart or say one of those second based charts, you could already see an opportunity to get in. Uh, so let's game it out. All right, we got three scenarios. One is that we could go back inside of yesterday's price action, which, I mean, literally while I was talking, we had the inside day breakout. So we just left yesterday's range. We just now performed an inside day breakout. One scenario would be that we get back inside of that range and that we maintain the range through the rest of the day. I would argue that there's two ranges to focus on. There's the Globex low and our current high. That would be one range. And then zone two, or the second range, would encompass all of that and also the rest of the price action from yesterday. And that would be the entirety of the range. I find it very unlikely that we'll maintain that first range. It's a very tight range from 44.32 to 44.62 or 65, right? Kind of could call it 72 just for some nice round numbers. So 32 to 72, 40-point range. Yeah, I don't believe it. I think we've got too much activity to stay in such a muted range, but that is one of the three scenarios. So what else do we got? If we're not going to maintain that range, well, what else could we do? We could break out of the range and begin an upside move. We've got an ADR right now of 1.5%. We're only up 0.25%. So we could go another 1.25. Just kind of price that in. Where would 1.25 put us? Just above this price action back here at 45.20 ish. Right? So that would be outside of the weekly expected move and an exaggerated push into the 45.20 area. Now, remember what we talk about all the time. Just because I can find some pivot points back here does not make those pivot points valid, right? We want to find more reasons or more ways to validate that area. We can say it's the ADR. Yes. It matches the pivot points. Yes. What else you got? Bring in something like the volume profile. So you can see that there's nothing here. A very minor amount of volume right around just above where I marked. So we could actually just move my mark up a little bit. It's there. It's not much, right? 4,500 on the other hand has a lot more resistance expectation than 45.20. So that's going to be what we want to focus on, right? And it kind of makes sense because we've already burned 12 hours of the day. While we have an ADR of 1.5, that is for an entire 22-hour trading period. We've only got like 10 hours left. So the idea that we make a move less than the 1.5 makes perfect sense. And the fact that there is resistance, at 4,500, is giving us some idea that that's very likely going to be the distance, right? We just broke through the average daily range high. That's what that alert was in the background. So we're going to be looking at 4,500 as first target and a critical level. If we should break through that, then second target would be 4,520. Now to the downside, should this begin to roll over and revert back the other direction, we would first give back the 0.75% that we're already up. We would test against our own Globex low, which is around 44.32. From that, 44.11, the cog line of and yesterday's Globex high, and then yesterday's open at 43.86. Now, if you're thinking, man, that's a long ways down. Yeah, but I don't think it's out of line. We have an ADR of 1.5%, and we're up, 0.75%. So if we give the 3/4 back and we add another 1.5 to that, it would put us in that area, right? So it's not out of line. But again, we do want to ask, is there anything that we're likely to tangle up with? Did we miss anything? And when we look at the volume profile, we can see that there's a concentrated level of volume down there, and there's actually the point of control at 44.42. We would need to get through that. That's going to take a serious amount of selling activity to push us through that level, so it wouldn't be subtle. And then there is volume support underneath the last line that I marked, the Globex, that 44.11 cog line. There's actually some volume underneath that right at the roundy 4,400. And it's very close to the value area low, 43.93, right? So um, it's unlikely that we'd breach below that level. It's unlikely that we would make it down to the 43.75 without having just some real serious economic news coming in. Wow. She's a going. And take that move and take a look at what's going on. Earlier, the dollar dumped and spiked the bonds and the stocks. Now we've got the dollar ripping to the upside, moving along with stocks, but not bonds. Just, it's like cats and dogs playing poker together. That ain't right. We have a really good idea of what stocks and bonds are supposed to do, how their relationship with each other works. And when they don't do what they're supposed to do, it just leaves us sitting here saying, well, okay, well, I mean, that's what it's doing. It's just not supposed to do that, but that's what it's doing. Recognize that the hedge trade is fading off a little bit this morning, and oil is getting ready to test the breakout. VIX is continuing to fade off. A little bit of that fade in the VIX. Be prepared for that, anyways, just because of drag. But on the other side of that as well, you know, it makes sense that when we have a breakout in the stocks, that we see that confirmed in the VIX. But as I've talked about lately, the VIX has been a very poor gauge of market sentiment. It's like investors have become so numb and they're tired of wasting that money on the hedge that they're just not using it. And instead, they're using the dollar more. And then, of course, in the last 5 hours, the dollar was a catalyst to the downside and now is a catalyst to the upside. Madness. I was just checking the news real quick, see if I missed anything. And the mortgage rates, that's it. And the mortgage rates aren't normally a catalyst like that. Okay, so now we're looking at the Nasdaq, and you can see that we are at a critical level. I want to take it out a little bit and kind of ask the same question that we asked in the S&P and the Nasdaq, or in the S&P. Are we above the 10-week? No. Are we extended a long ways away from that 10-week? No. In fact, we're getting ready to make that crossover. So the 10-week is healthy. What about the 10-day? We are above the 10-day, and we just made that transition from yesterday into today. So we just got the crossover. So we're not overextended. I love it, Nicole. That is exactly right. Sometimes it just is, right? It just, that's just the way it is sometimes. It's nothing you can do about it. Just recognize that that's what's going on and shrug and make money on it. So we can look at the NASDAQ right now. And as much as this feels like it went a long way, we can definitively state that we're not overextended. That's the only thing we need to look at these for. There's no reason to leave them on the chart. Looking at the NASDAQ here on the 1 hour, you can see that we're coming into a critical area of resistance. Now, again, just because I can snap a line there and say it matches these previous pivot points, and in fact, we can take it all the way back to a couple of weeks ago, and it would still match those pivot points. That doesn't mean it's a valid level, right? I want to take it and put more validity into it somewhere. Notice how shallow the volume profile is right there, right? I mean, it's just really, really shallow. We will be able to move through this area really quick. So this is not a strong level of resistance. This is like no resistance whatsoever. And that provides some real value to our understanding of how strong is this level. Should I short it here? Not based on any form of support and resistance, no. You might want to short it just because of how big that candle is, a little bit of micro mean reversion. But you wouldn't want to see that line in the sand and say, well, it matches all these pivot points. I drew a line there. It's a solid pivot. Let me go short against that. There's nothing there, right? So if we had approached it in a more normalized state, grinding our way up to that level, that would be completely different. Instead, we approached it with this big monster, just blowout candle. And since there's nothing there, it's very likely to just keep on going. Right now, whether it does or not, I mean, I don't have my crystal ball lit up this morning. Got to put new batteries in it, but you just see what it, played out. High probability says this is a good place to short. You know what I mean? Like it's called POP, probability of profit. This is a high pop trade right there. To short that. On any other day, that would be a shorting opportunity. But with stocks and bonds and the dollar acting so odd this morning and just the strength of that move, unless you're scalping, I wouldn't short it there, right? I would sit on my hands and wait for a little more information. So let's go ahead and map out the range of the day. We have the same scenario as the S&P. We could stay in the range for the day. That's always on the table. I find it unlikely. What would be the range? I would use two different zones, just like I did in the ES. So our own Globex low and our current high, which puts us around 14,040 all the way up to 14,300. It's a significant range. But that would be range one or zone one, area one. Then you could add the rest of it, which would be all of yesterday, including the Globex low. We are on an inside day breakout right now, by the way, right? When we draw that line in the sand at yesterday's high, when we break through that, then we are on an inside day breakout. So the idea that we could maintain inside of yesterday's range, well, that's already off the table because we're outside of yesterday's range, but we could come back into the range. And that is a really big range, and it could be our trading day. If we fail to break out, I find it very likely that that will be our trading day, taking us all the way down to 13.8 and as high as 14.3. It's a 500-point range. That's a very large range. We want to add some pivots to that along the way. Our own Globex low is a pivot. Where we closed at 4 o'clock, you could mark the open of Globex or um, the IB, the initial balance, which would put us at around 14,100. We have yesterday's high as another pivot, and we have that 1130 pivot. So all of those pivot miners, tree branches to hit on the way down. We wouldn't look at those as support necessarily, just levels where we would expect an interaction with price. First touch pullbacks, pauses, slight consolidations, and then using those for milestones or markers and kind of asking, hey, are we there yet? Are we there yet? How about now? We there yet? In the unlikely scenario that we happen to break this high and continue to go higher, let's add a little bit of context to that. What's out there and how far could we go? Well, we know it's a very shallow volume area, so there's no resistance. 14,600 is 2% from our current location, and it fits right around our ADR. But we want to validate that level and make sure we're not just pulling numbers out of a hat. All right, so 14,600, take it back over to the volume profile. We have a point of control at, we're just going to add 10 points to it and say 14,500. That's not spot on perfect, but it's close enough. And although the green is probably a little hard to see, it extends a long ways, right? So there's a lot of volume resistance there, call them volume nodes. So while we could get to 14,600, I think it's going to be very difficult to get above 14,500 without some kind of catalyst to galvanize this market and push us farther. And again, look at how shallow that area is. There is just nothing there, right? On a 10-day. So let's take that statement in just a little closer. If that's the 10-day and we're talking about there's no volume there, what about on a day-to-day? Or for a 5-day? So looking at this 5-day chart on a 5-minute, it's called a 5x5. We can see that none of these previous days have any significant volume at our level or above our level. So that's not going to be very useful. Take it back. Set the 5x5 here. Right. So now the green is measuring all of those 5 days combined and asking, is there anything there? Of course, in the last 5 days, we haven't gone above that level. So there's nothing on this 5-day that was going to help us out. How about the 20-day? 20-day 1 hour still shows there is nothing here, right? There's just literally nothing here. And if you look at what there is to measure, it's just from the last week. That's it. If you look at last week, then it was Thursday and Friday right on those lows. So there is no resistance there. And I've had someone ask me before, how do you find any value out of these volume profiles? They're so far back, right? I need to worry about what's going on now, not what happened last week. Well, when we draw a line in the sand connecting these pivot points and we say that's resistance, I just proved to you there's no resistance there. There's nothing. So you wouldn't want to go in and try to short this sucker just because you can match some wicks together or some pivot points, right? Now, again, because we hit that with such a very large candle, we're very likely going to pull back from that level. but it's just because of that, right? Not because we found some volume nodes there or some form of resistance. We always want to find a way to prove that our lines are valid, right? And sometimes we can't. Sometimes we can't prove it and we just have to take it on faith. Yeah. All right. So we got that breakout in oil, but it seems like it's trying to fail. The VIX continuing to resolve the drag. Dollar still mean reverting. The bonds stabilized across the top. Really important to recognize that in the bonds. So we'll just kind of zoom in here a little bit. Add another day, perhaps. Now, when it comes to the bonds, it's not just, oh, well, we got to move to the upside. Look at the absolute devastation in this market, right? Since August of last year, it's just been a slow grind to the downside. And then in the last few weeks, it's picked up its pace significantly. When we're talking about mean reversion and linear regression, we've expanded beyond the uh, the mean significantly. So we have the expectation that it's going to pull back and come back towards us just from being too far from the mean, not because we're bullish or in any way at all. Selling bond puts, by the way, is looking really good. It's looking really good. Now, yesterday in oil, we had that really nice failed flag play, and then that failed, right? So it took the low yesterday. We came out of that channel nicely, and right about, oh, my line is still there. Right about where that line is at 314 yesterday or 214 yesterday. I get the heck out. Oh boy, I got out just in time. Missed the dump. But it looks like we're going to get another shot, right? So might have an opportunity to play oil today. Got a bit of a wedge. We're breaking out of the top of that wedge. Remember that with these higher lows in this wedge, but we don't have a higher highs in. It's not a rising wedge the way we would normally look at them. We would still have an expectation of a downside break, not an upside break, especially when we're talking about a break after the low of the move. So, be watching this for a Busby, perhaps a pullback and validation of the resistance at the 103, and then a continuation to the upside, tagging back through these levels. Keep your eye on the dollar and the bonds today, guys. It's going to be the most insightful thing that you can watch for opportunities today. That's just, I mean, there's no other way around it. I'm going to continue to make this a part of my morning routine now, coming out to the daily charts on the FANG names, which, by the way, due to the earnings in Netflix, it no longer has the weight to even be in the FANGs list. So we're going to be removing that. I've been arguing that Facebook also should be removed, that it no longer has the weight. But, we get stuck in the same habits, just doing what we do consistently. And I tend to leave them in there. I probably still will for a while, but, you know, um, we could point to something like UNH with a greater impact to the market than Netflix or Facebook, right? Sad to say. We do have the double butterfly on in Tesla. It's going to be interesting to see how that works out. The two butterflies combined are only risking $60, basically $30 per butterfly. And if for some crazy reason Tesla reports and actually doesn't go violent and hit either one of these and just stays in the middle, then we're going to convert those two butterflies into an iron condor so that we'll get paid for it to stay in the middle. Right. Or, and I've been thinking about this, depending on the buying power required, we'll convert at least one of these into a broken wing butterfly, right? We'll take one leg of that butterfly and roll it out, not out of the series, but just, higher or lower, depending on which one of these we happen to convert. Otherwise, we want to look at the daily chart and kind of get an idea of, is there an opportunity out there? Since we get the same setup across the field in most of these, unless they have their own news that makes them leave the group, like Netflix is completely outside of the group at the moment, then we can look at them in their aggregate. Are they all presenting a trend line breakover? Are they all presenting an IX10, an R2G, inside day breakout, right? Because combined, if price is the best indicator you could ever bring up, then looking at more price gives you more information, right? The more markets you can look at, the better. So if we can validate the same bullish break or bearish break, if we were running it the other direction, if we can confirm the same bias across all of the fangs, then the likelihood of being able to run our alpha protocols of seeing a highly correlated market state, like 90 to 95% correlated market state, will give us that validation to pull the trigger. If you look at what the market correlated state was in the Nasdaq yesterday, we were running at plus 90% all day. Right now, I did change these yesterday from being just the advancing issues to the advanced decline. That's why there's actually negatives now. It's taking the advancing issues and subtracting it from um, the declining issues, and then the difference between those is what this chart is using. This is for the Nasdaq, and this is for the S&P. This is not an indicator that you see on the screen. It's actually me just using the drawing tools, right? Sometimes the drawing tools are the best thing that you could do. I thought about coding an indicator for it, but I mean, what's the point, right? When you just draw a line. So we want to continue to focus on the correlated market state. A highly correlated market state is a very dangerous market. It can move very fast, can become very extreme in its movement. I think we've kind of seen some examples of that yesterday. Look at the speed and pace and scope of the move yesterday, and then look at the highly correlated market state that we were in yesterday. I tried to activate the alpha protocols yesterday. I didn't get filled in a couple of products, and I took a loss in a couple of products. One of them was Baba, one was AT&T. Um, but for the most part, on the ones that I got filled on, everything turned out really good. And net at the end of the day, it was a profitable day. The alpha protocol that I designed is that when we have a highly correlated market state, I buy every name on this list. It's my list. You're going to want to make your own list. But if you're in a highly correlated market state where 95% of the entire market is all moving like SPY and SPY is moving like a rocket in space, then you would just buy every single name. You wouldn't need to go in and be particular about, you know, uh, um, is it at support? Is it at resistance? Is it pulling back? You know, is this the one that I want? Is there one better with a better momentum or a better trend? It's a highly correlated market state. Trade the basket, the entire basket. Buy every single thing on your list. That's what the algos do, right? It's where I got the idea for the alpha protocols in the first place. If the algos will catch a headline in the news and then go out and activate buying activity or trading activity throughout the entire basket of stocks and drive our market because of it, well, why can't we do the same thing? And I've gotten to the point where I'm doing it and it works. I didn't have to go in and pick markets yesterday. I just had to go in and continue to bump the order until it got filled because I wasn't going to market order into some of these names. And then I had to go back and kill the ones that weren't doing good, like Baba and AT&T, right? And it doesn't matter that I had a couple that lost because predominantly I had a lot of them that won. I've been using a 45-ish on the Delta, right? Kind of just slightly out of the money, but that doesn't work for everything. And you need your own list. My list comes from the CBOE website of the most heavily traded products of last month. And so every month I look back at the previous month, I get the list, cut it down to size, and I go in and evaluate all of their options on a day-to-day basis, just kind of asking, okay, if the situation happens and I was going to come in and be buying all of you, which strike am I going to focus on? It's a simple process, it's a simple protocol. The only hard thing is actually doing the thing, right? It's kind of uncomfortable to go in and just start buying across the board, but it works. Options Alpha actually has bots that will do it for you so that you don't have to be emotionally invested. But I don't have access to that bot, and I hear it's kind of expensive. I can manually just go in and trade it. So, I don't need the bot to do it for me. But you could. You could use the bot, program it, and it would just do that trading, get you in and get you out of the market without any input whatsoever from you. Cool. All right, let's get it wrapped up. Looking at the sectors: marijuana, natural gas, semis, oil, Bitcoin, technology, small caps. All of those are above 0.5% this morning. And I'm going to bring up trading view so we can quantify that statement a little better. We're seeing a little bit of weakness in financials and the Qs, the QQQ, which, interesting enough, it had more volume this morning than SPY did. By a significant amount, it had more volume this morning than SPY did. Emerging markets is up slightly, not as much as I would like to see if we're so bullish. Why is that not up more? That's our global gauge of a risk-on sentiment, and it should be in line at least with the S&P. So seeing it down like that kind of um, indicates a little bit of uh, global weakness. All right, so let's bring up the heat map and do it this way rather than trend spider. We want to adjust what we're looking at to pre-market. We're going to use the filter to get rid of 500 names and knock this down to around 100 names, which is kind of hard to do. 90 is close enough. We got to adjust the color. See how there's a lot of gray? Even though things like Tesla are up 0.5%, it still didn't change the color. So it's just a simple fix. Knock that down into a decimal. Now we can see the fangs stand out really well, right? Tesla, Amazon, Apple, Google, Microsoft, Facebook. Those stand out really clear. And we are risk on in all of those by a significant value, too. We got nearly 1%, Apple and Google and Microsoft, right? Now, Amazon uh, may be the play of the day, really, if we can get a turnaround in that retail. Just keep in mind, we got Beige Book today, too. So I'm going to be watching Amazon close for that opportunity. Um, the financials, mostly flat, got a little bit of love in there. Now, keep in mind the S&P has the financials. The Nasdaq 100 does not have financials, right? So when we flip this over, and we're no longer looking at the S&P, but we instead are looking at the Nasdaq, well, you can see the FANG names still stand out very clearly. Give it a little bit of color adjustment. Transportation's looking good. Consumer non-durables, health technology. I mean, everything's looking really good. I see a lot of weakness in retail this morning, which kind of makes sense when we got some econ going to be pointing in that direction. And when it comes to technology services, yeah, D-Dog, Netflix, Facebook, W Day. I mean, there's some pretty good names in there that are down. All right. So, how many names are up in the pre-market in the S&P? At least 1%. Only 9 names. That's not very significant. And if we look at it, um, a couple of them are FANG names, which is significant, right? We got Microsoft and Intel and Nvidia. 3 FANG names. Well, Intel. Let me restate that. Microsoft and Nvidia, 2 names on the FANG name list. But how many names are up at least a half of a percent? 38. Now, it's a slightly bullish number. If we were seeing something like 65, 85, 90% up at least a half of a percent, that would be a lot more bullish in my sentiment. Of the names that are up, we want to take a look and see if there's a particular sector that stands out or a particular industry, sub industry. If nothing really kind of gets our attention, then it's not a big deal, right? We just want to look to see if there is actually anything that's standing out. You know, don't force the issue. If there's nothing there, then there's nothing there. I think a lot of us make that mistake, though. We try to force it and say, "Well, I'm looking for this thing." If it's not there, it's not there. Just let it go. I see that mistake done in indicators a lot. Things like a MACD or an RSI that people will read into it and say, "Well, isn't that a signal? It kind of moved." No, it's not a signal. Seems like price broke through the ADR high again. That's what that alert was. All right, so now we're looking at the Nasdaq. How many names are up at least a half of a percent? 16. That's more than in the S&P. How many are up at least a half of a percent instead of the 1%? 50. So 52% of the Nasdaq this morning is up at least 1%. That's a reasonably decent bullish number. What's the difference between those two markets? Well, the Nasdaq does not have financials, right? The Nasdaq 100 does not have financials. So just out of my own curiosity, names that are down at least a half of a percent in the S&P, are any of them financials? Nope. But okay, well, I mean, at least we looked. So we're slightly bullish this morning, not exaggerated bullish. And something like Amazon has the opportunity to play catch up. I was curious to see how much volume we had this morning, and it's a negligible amount, just a tiny amount of volume, right? So, like nothing. Still, we want to watch this, look for an opportunity, see if we can finally get this breakout. Be careful, though. We are going to be kind of matching up into that megaphone top, that angled resistance. Looking at it from another point of view, we are not yet near the resistance from the high of late March, and this would be considered a trend line breakover. Yesterday would be. It's too late now, right? So we basically want to watch this for a continuation or a fail play. All right, guys, that's what I got. Be careful, be safe, and it is my day to stream. So I will see you all in the large caps room at 9:15.